Hello everyone, I'm Ian. The other three group members in the team are Lilian, Rachel, and Sonia. Several weeks ago, some teams had done a qualitative analysis for company strategies. Today, we are going to do quantitative analysis based on advanced DuPont ratios to help you understand the performance of the company. Return on equity is the key point for a systematic analysis of a firm's performance. It indicates how well the managers applying the funds invested by shareholders to generate the returns. The advanced DuPont formula is a tool decomposing the return on equity into two components: return from operating activities and the return from financing activities. Before calculating the ratios, we needed to reformat the income statement. The raw income statement does not show all incomes from all sources. The other comprehensive income needed to be identified and added back to the income statement. The slide has shown you the steps about calculation and adjustment for the net operating profit after tax, net financing expense after tax, and comprehensive net income. In this case, the other comprehensive income has been reported under shareholders' equity account, and we assume tax rate is 30% to calculate the net finance expense.
Hello everyone, my name is Lilian. In my part, I will present how to reformat the balance sheet of the crispy company. Actually, there are 3 steps to follow if you want to reformat the balance sheet. In the first step, you should identify operating and financing activities. It's very easy to identify the operating activities, but we should remember that if you want to identify the financing activities, this item should bear a market rate of interest. So according to the balance sheet of the company, there are 2 financial assets. They are cash and cash equivalent and short-term investment. As for the financing liabilities, there are only one account. Is current maturities of long-term debt. After we identifying the operating and financing activities, in the next step, we will use the equations to calculate net operating asset and net financing liabilities. The equations have been represented on the PowerPoint, so it's very easy for us to calculate them. In the last step, we should check the balance sheet. We must make sure that the balance sheet still balances, so the net asset equals equity equals net operating assets minus net financing liabilities. So if you finish the reformation of balance sheet, you can calculate the next part. So next, welcome our teammate Sonia.
Hi everyone, I'm Sonia. In the next few minutes, I'm going to examine the composition of advanced DuPont formula we use to calculate the return on equity. Now let's have a deeper look at the advanced DuPont formula. We can see that in the advanced DuPont formula, ROE is separated as return from operating activity and return from financial activity. Let's first look at the return from operating activity. It is composed of operating margin and asset turnover. Operating margin, calculated as NOPAT divided by sales revenue, gives an analyst an idea of how much a company makes on each dollar of sale. When looking at operating margin to determine the quality of a company, it is best to look at the change in operating margin over time. If a company's margin is increasing, it means it is earning more per dollar of sales. The higher the margin, the better. For asset turnover, since in advanced DuPont, the asset turnover is calculated as revenue divided by net operating asset, meaning that the amount of sales of revenue generated per dollar of operating assets. It is an indicator of the efficiency of deploying assets. Generally speaking, the higher the ratio, the better it is, since it implies the company is generating more revenue per dollar of the operating assets. Finally, let's look at the financial leverage. Although using debt increase the company's risk of bankruptcy, it also increases the company's return. especially its return on equity, because if debt financing is used rather than equity financing, then the owner's equity is not diluted by using more shares of stock. So it is very important to evaluate the financing influence on ROE. Thank you. Next, please welcome my teammate Rachel to explain the data calculated by our team.
Hello everyone, I'm Rachel. In this part, I'll discuss the implication of above analyzed ROE for Crispy Company. Firstly, we use operating return on asset to measure the operating profitability. From this graph, we can see that from 2000 and 2002, the operating return on assets is increasing from 0.10 to 0.15. For better understanding, we can disaggregate operating return on assets into two parts, profit margin and asset turnover. We can see that Crispy Company increased its operating profit on assets by increasing its profit margin and decreasing asset turnover. Secondly, we measure financial decision for company profitability by the multiplication of financial leverage and spread. From the figure, we can see that financial leverage for 2000 is much higher than the figure 2001 and 2002, but the spread is a little bit lower than that 2 years. And after the multiple calculation give us a Crispy's overall financing impact on ROE. After separate discussion of the effect of how operating performance and non-operating performance on return on equity, finally, the combination of these two parts give us Crispy overall profitability and potential growth for year 2000 to 2002. Thanks a lot. That's all contents of our presentation.